Welcome to Market Call. David Burrows is on our show today, President and Chief Investment Strategist at Barometer Capital Management. And he's going to take your calls, emails and tweets on North American large caps. You know that number, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. Great to see you. Feels like a while.
Good to be here. It has been a little while.
Let's pull up the old 1 year for the S&P 500.
Sure.
What's your feeling on the market right now?
So I think that there is a tremendous amount of concern around trade, around the economy, news flow, and there is incredibly defensive positioning in the market. I think that what happened through 2018 was we came in hot, the rate hikes cooled expectations, and we discounted some slowdown in some of this that we're going through on trade. But I think that the fear in the end of the year really was overdone. And our view was it was bull market correction. And here we are back very close to highs, even though the concern around the news flow is peaking as it did in 2011 around the European debt crisis, as it did around Brexit. And we know what happened when those concerns got to these levels. Even though they resolved in a way that you didn't really expect them to, like the election, for instance, market was able to take off. So I think that the market's discounted slowdown in the first half of 2019. Actually, the data hasn't slowed nearly as quickly as people thought. And I think that we're now facing some positive catalysts. You know, we're facing a more friendly Fed. I think that it's potentially we've faced 18 months of difficult trade news that can easily start to get better. And when the market's trading basically at highs and there's all these concerns built into the market, it's telling you something. There's other things going on that are supporting price. So when we look at the groups, defensives are roughly twice as expensive as they've been historically versus the market. Cyclicals are cheaper than they've been since 1980. Now, I don't know of a bull market that ended with everybody defensive and sitting on the sidelines.
Right, meaning that people are dry powder.
There is no euphoria. There is no reach. Long positions in S&P 500 contracts are as low as they've been since 2011. Volatility is low. Stocks and sectors are not acting with a high correlation, like there's some big systemic problem. So my sense is the market has discounted slowdown. People have positioned very defensively. And my view is that the pain trade is much higher.
What do you mean the pain trade, sorry?
The pain trade is the thing that hurts people the most. Rarely does the market get set up perfectly just in time for a turn down in the market, right? We're sitting at highs. People get positioned too far in one direction. So this market takes out these highs by any measure, any kind of follow through. The pain trade for the rest of the year will be much higher and people will chase.
What is the pain trade? That's the thing I can't quite get.
The pain trade is what the market can do to put people on the wrong side of it, right? When everybody's on one side of the market, they're rarely on the right side.
I see, yeah.
Right? So the positioning right now is extremely defensive. The number of managers who say they're overweight equities is at the same levels it was at in 2011. The volatility levels, they're not pointing to some kind of problem. When people pay 50 times earnings for a bond, which is effectively what you were paying for tech stocks in 2000, right? 2% yield.
Oh, I see.
And when you're paying twice the market valuation for defensives, they're pretty expensive. They're not so defensive. And you're supposed to buy cyclicals when they get cheap relative to the market. Now, when I look at the signaling in the market, the railroads are acting great. The semiconductors have been acting great. If you take a look at a 5-year chart of Rio Tinto, one of the biggest miners in the world, or BHP, they're trading right close to highs. That's not the market telling you you're headed into a recession.
Okay, that's interesting. Yeah, so despite the gloom in the headlines, you think there's positive factors.
This has been getting discounted into the market for 18 months. Earnings did not roll over and go into an earnings recession. revisions are not pointed that direction.
Okay.
So we're quite bullish.
Okay, well, we're going to get more of David's calls in detail here. David is President and Chief Investment Strategist at Barometer Capital Management. Answering your questions on North American large caps, 1-855-326-6266.